Hey guys, welcome back to the channel. Today I'm going to talk about two ETFs that I found while I was trying to do a screen on monthly paying ETFs. And these looked interesting, um, but unfortunately it's not quite what I thought they were. So I just want to go over my initial thoughts on these ETFs. Like at first, the Amplify ETFs they look okay, but I don't know. Look, the way they're structured seems kind of shady. But it could just be my imagination. They're not These two ETFs are not agricultural or commodity related, just based on the name alone. Because I thought they were pretty interesting. I thought this might be a good way to diversify on certain investments. And I think the name like cows and HCOW might be referring to maybe cash cows. That's the only thing I can think of. But I personally haven't gotten any yet. And if you don't have any, maybe if I were to start, maybe like trial positions. So the first thing I want to point out is that the index for this particular these two sets of ETFs are from this gentleman, Kevin Kelly. He's the CEO of Kelly Intelligence. So cows would be like the dividend paying ETF, and then HCOW adds a layer of covered calls on top of cows. And I'm not sure if I like calling this double dip because it does seem like it's double dip because like he's the CEO of like this index, and then there's also Krista Kelly, which I'm not sure if they're siblings or if they're married or what. It's not like a deal breaker, but maybe if they could clarify the relationships a little bit more. But they do disclose it in their prospectus, so if you go back to like the management of the fund, um, the I guess they have a few portfolio managers, so it doesn't seem as bad. They do have like two CFA charter holders, so maybe I'll take a wait and see before I pass final judgment. The Like I mentioned before, they have interesting ticker symbols. The expense ratio isn't too bad for a covered call fund; it's 65 basis points. But unfortunately, it's still relatively new, so they don't have uh, I guess like a yield number to kind of compare against other ETFs yet. So I'm gonna hold off until they maybe like a few months and see if they are able to maybe get a decent yield that might be attractive. And this is like the second thing I'm not too sure about their call income strategy. I thought they were gonna sell either covered calls on the the cows ETF itself, or maybe like some of the underlying stocks like sell covered calls against each of the individual holdings. But they look like they're I guess trying to maybe save maybe some money on individual covered calls and just doing a maybe a covered call strategy on the SPX options. So it's the broad-based index options. So maybe that's why they're doing it that way. Um, but then there's also if you read through the perspectives, this is another part that I'm not sure. This is kind of like a con for me. They want to implement this call income strategy by going into swap agreements, and that kind of turns me off. I don't want too much complication within a ETF. I mean, if that's the case, I might as well just do this myself. Uh, but that's just me. It's just my opinion. Don't let that color you. If you find this to be more convenient for your situation, and the management fee for the cows ETFs is a little not weird, but I guess I haven't seen this too much where it's supposed to be 39 basis points, but they're waiving it for the first year. So so technically it's a free ETF in that you don't have to pay an annual expense ratio, at least for now. And they also have it set up so that it's a monthly distribution. So that's probably a good thing. So according to their marketing materials, it's they're ranking their underlying stocks by high free cash flow, and then as a secondary priority, like the dividend growth. So they're I think this is good that they're trying to make this ETF more sustainable over time. So, but the bad news is that it probably won't be a traditional high yield. I think maybe the base level dividends will be maybe around maybe 4 to 5% optimistically, and then if you want to uh, get additional yield on top of that, the HCOW, that might bring it into like maybe the high teens. So it's not too bad, but I don't know if it's worth the risk of like having the swap agreements. That because then that introduces counterparty risk because it's not clear who which banks or investment banks or even like another financial institution is taking the risk of like the cows ETF. So I dug deep into some of these companies because some of these companies that within the ETF I've already had trades on prior to this, just by coincidence. So, for example, Cheniere Energy, this is a gas company, so a natural gas company, and hence why their ticker symbol is LNG. So I've had a good success with this particular um, stock just for trading, covered calls and cash secured puts in the past. So I can vouch for this one. Williams Sonoma, at least I've heard of. Chevron, I think most people have heard of. Laboratory Corp, again, I think most people have heard of. Westlake is a chemicals company that I've also have traded in the past, but not that much. So some of these stocks I haven't seen before, so I'll probably take a look at just to see if I want to do this myself or maybe just do the ETF. So the fees are maybe a little bit funky for now because like if you're doing if you already own uh, one, it probably doesn't make sense to own the other. For example, if you have HCOW, you're already paying a 65 basis points as an annual expense fee, so it doesn't make sense to own both at the same time. And then cows might be the better deal for now, where it's supposed to be 39 basis points, but they're having I guess a special uh, for maybe about a year or so. So maybe if you are going to invest, maybe cows might be the better deal. But again, they haven't paid out anything yet, so I'm personally going to hold off. So I think the pros is if you own just one, it could be convenient. It might be good for smaller accounts if you're trying to diversify uh, with cows along with your other portfolio holdings. I think that could be good. But for me, though, I think the risks outweigh the reward here. Um, as with most covered call ETFs, like you don't have control over the option strikes. And then this the HCOW ETF has uh, an additional layer of counterparty risk because they're using swap agreements, and it's not clear which financial institutions they're hedging with. So this this might make the yields inconsistent from month to month, uh, depending on the strategy. So, and then there's also the expense ratio for cows. It might balloon in the future, so it's something that you might want to keep track of. And of course, like both of them are still new, so we don't even have like the actual yield to see if it's even worth putting in your portfolio for now. So I'm personally gonna hold off, but I just wanted to give you guys my thoughts. If you can like and subscribe this video, that would be great. That would really help me out. So thank you for watching and have a great day.